Welcome to Blue Nile Tutorials. In today's session, we're diving into our 11th chapter, Income from Self-Employment Capital Allowances on Cars. For self-employed individuals, claiming tax relief on business vehicles can be a key part of managing your finances effectively. We'll break down how capital allowances apply to cars, including the rules for co-emissions, the types of allowances available, and how to calculate writing down allowances or claim first-year allowances via, whether you're driving a hybrid, electric, or traditional vehicle. Will help you understand the tax implications step by step. So, let's hit the road and simplify capital allowances on cars. Let's get started.
Welcome to this video on income from self-employment, capital allowances on cars. In this session, we're going to consider what capital allowances can be claimed on cars, as these are quite different to the treatment of general plant and equipment considered in the last session. The main rules for us to take into account with cars are: there's no AIA allowed for the purchase of cars, although it is available on the purchase of a van. The WDA for a car is based on the level of CO2 emissions. And if a car is used by the business owner for both business and personal purposes, will only be able to offset part of the allowance against profits. This rule applies to any asset that is partly used for private purposes, although it is mainly cars where we see it occurring. Looking at the CO2 emissions first, the current rates are CO2 emissions up to 50 grams per kilometre, 100% first year allowance. CO2 emissions of between 51 and 110 grams per kilometre, 18% writing down allowance. And CO2 emissions of more than 110 grams per kilometre, 8% writing down allowance. This means that low and medium emission cars form part of the main or general pool, but high emission cars have to be put instead into the special rate pool. If the issue of personal use by the business owner is relevant to any car, it's not pooled, but instead will appear in a separate column on its own. The first year allowance is a new allowance to introduce you to in this session, as it's only available on these low emission cars. This is called a spot allowance, as it's available on the date of purchase rather than for the accounting period. What this really means is that there's never any time apportioning of first year allowance, even if the accounting period is longer or shorter than 12 months. Let's look at some examples. Example 1. Kate buys one car costing £18,000 for use by an employee for both business and personal use with CO2 emissions of 48 grams per kilometre. She then buys a second car costing £22,500 for business use only with CO2 emissions of 105 grams per kilometre. The capital allowances for the 12-month accounting period of purchase would be, for car 1, being low emission, 100% first year allowance of £18,000, and for car 2, which is medium emission, it'll be 18% writing down allowance at £22,500, therefore £4,050. So total allowances for the 12 months will be £22,050. Note that the personal use of car 1 is ignored, as this is by an employee and not the business owner. Example 2. Lisa also buys one car costing £18,000 for use by an employee for both business and personal use with CO2 emissions of 48 grams per kilometre, and then buys a second car costing £22,500 for business use only with CO2 emissions of 105 grams per kilometre. The capital allowances for the 9-month accounting period of purchase would be: car 1, low emission, will be 100% first year allowance of £18,000, and car 2 would be a medium emission car, so 18% writing down allowance multiplied by 22,500 multiplied by 9/12, so £3,038. So total allowances for the 9 months will be £21,038. Note that only the writing down allowance is time apportioned, not the first year allowance. Example 3. Mary again buys one car costing £18,000 with CO2 emissions of 48 grams per kilometre, but this time she will use it herself for both business and personal purposes. She estimates that she will use it personally 15% of the time. She then buys a second car costing £22,500 for business use only with CO2 emissions of 105 grams per kilometre. The capital allowances for the 12-month accounting period of purchase would be: for car 1, which is low emission, 100% first year allowance of £18,000 multiplied by 85% business use, so £15,300. And for car 2, which is medium emission, it'll be 18% writing down allowance multiplied by £22,500, so £4,050. Total allowances for the 12 months then is £19,350. Note this time that the personal use of car 1 is relevant as it's the business owner using it personally. The effect is that the 100% allowance of £18,000 is restricted to the proportion of time the car is used for business purposes. So now let's try and put together all of the capital allowance rules from this and the plant and equipment session to work through a full example. Ming prepares accounts to the 5th of April. On the 6th of April 2018, the tax written down value of the main pool was £16,700. The following transactions took place during the year ended the 5th of April 2019. On the 8th of April 2018, purchase of a motor car 1 for a cost of £15,600. On the 14th of April 2018, motor car 2 was purchased for £10,100. On the 12th of August 2018, equipment was purchased for £218,750. On the 2nd of September 2018, motor car 3 was purchased for £28,300. On the 19th of November 2018, motor car 4 was purchased for £16,800. And on the 12th of December 2018, motor car 2 was sold for £8,300. Motor car 1 has got CO2 emissions of 100 grams per kilometre and is used by Ming 20% of the time for personal purposes. Motor car 2 has CO2 emissions of 155 grams per kilometre. Motor car 3 has CO2 emissions of 105 grams per kilometre, and motor car 4 has CO2 emissions of 40 grams per kilometre. The calculation would always start with setting up the opening point. The tax written down value brought forward here, £16,700 on a main pool only. The next thing to look at is any purchases during the year which qualify for AIA. Remember that cars don't qualify, so here all we're looking at is the equipment purchased on the 12th of August. As Ming spent more than £200,000 of the maximum AIA, we claim AIA of £200,000 and carry the surplus expenditure of £18,750 into the main pool. Now we start to look at the cars. Car 1 is a private use car as it's used by Ming, the business owner, personally as well as for the business. This means this car must appear in its own column. Car 2 is a high emission car, so needs to go into a special rate pool, which doesn't currently exist. So, again, we need to set up a column for this new pool. Car 3 is a medium emission car, which can add into the existing main pool. And car 4 is a low emission car qualifying for the 100% first year allowance, but technically part of the main pool. Now that we've dealt with all of the additions, we need to deal with one disposal, of car 2. This car was included in the special rate pool earlier, so we need to deduct that from that pool, at the lower of the original cost of £10,100 and proceeds of £8,300. We've now adjusted the columns for all items purchased and sold in the year, so we need to consider what allowances are appropriate. Remember, there's no balancing allowance on pools unless the business ceases to trade, so even though we know there are no items left in the special rate pool, we can't claim a balancing allowance. We therefore need to give an 18% writing down allowance to the main pool, so £63,750 multiplied by 18%, giving £11,475, and an 8% allowance to the special rate pool, so £1,800 multiplied by 8%, giving £144. This just leaves us the private use car to work on. This car was separated out because of private use by the business owner, but the allowance is still based initially on the CO2 emissions. Car 1 has CO2 emissions of 100 grams per kilometre, so it is a medium emission car on which the 18% writing down allowance is available. £15,600 multiplied by 18% gives us £2,808, and the value of the car is reduced by this amount. However, the actual allowance due claim is restricted to the 80% business use. In other words, 2,808 multiplied by 80%, giving £2,246. So to total up our allowances for the year, we claimed AIA of 200,000, 100% first year allowance of 16,800, writing down allowance on the main pool of 11,475, and on the special rate pool of £144, and on the private use car of £2,246. Total for the year then is £230,665.